Imagine doubling or even tripling your returns with just one trade. Sounds like a dream, right? But what if that dream quickly turned into a nightmare, leaving you with massive losses? Leveraged and inverse ETFs are two of the most exciting yet risky investments on the market. They're often marketed as tools to supercharge your gains or protect you when the market takes a nosedive. But these financial instruments are not as straightforward as they might seem. While they offer the potential for high returns, they can also magnify losses at a pace that leaves even experienced traders in shock. In this video, we're going to break down exactly what leveraged and inverse ETFs are, how they work, and why they carry such significant risks. Whether you're a seasoned investor or just starting out, it's crucial to understand the hidden dangers before diving into these investments. By the end of this video, you'll know if these ETFs are a clever strategy for quick gains or a ticking time bomb in your portfolio. So, let's get started. Chapter 1. What are leveraged and inverse ETFs? Leveraged and inverse ETFs are specialized financial products designed for traders, not long-term investors. But what exactly are they? Leveraged ETFs aim to multiply the performance of a specific index, such as the S&P 500. For example, a 2-time leveraged ETF will seek to deliver twice the return of the index for a single day. So if the S&P 500 rises by 1%, the ETF aims to go up by 2%. However, the flip side is that if the index drops by 1%, the ETF will lose 2%. Inverse ETFs, on the other hand, do the opposite. They are designed to profit when the market falls. For instance, if the Nasdaq drops by 1%, an inverse ETF tied to the Nasdaq would aim to gain 1%. These ETFs use complex financial instruments like futures and options to achieve their targets. However, here's the catch. Both leveraged and inverse ETFs reset daily. This means they're built to match their performance objectives over a single trading day, not over weeks or months. Holding them for longer can lead to unpredictable results due to the compounding effect, especially in volatile markets. Simply put, while these ETFs might seem like a quick way to maximize returns, they come with significant risks that can easily wipe out gains if not handled properly. Chapter 2. Risks of leveraged and inverse ETFs. Now, let's get into the risks. Leveraged and inverse ETFs might sound tempting with their promise of multiplied gains, but they come with serious downsides that many traders overlook. One of the biggest risks is compounding. These ETFs are designed to match their daily targets, not over weeks or months, but over a single day. Here's why that matters. Let's say the S&P 500 rises by 5% one day and falls by 5% the next. You'd think a 2-time leveraged ETF would break even, right? Wrong. Because of the way compounding works, you could end up with a loss even if the index returns to its starting point. Then there's volatility. In stable markets, these funds might perform somewhat predictably, but in choppy conditions, they can go haywire. When markets swing up and down, leveraged ETFs have to constantly adjust their positions. This frequent rebalancing can eat away at your returns due to transaction costs and fees. In fact, during times of high volatility, like the 2020 market crash, many of these funds saw significant losses and even liquidated. Another hidden risk? Derivatives. To achieve their performance, these ETFs use complex instruments like swaps and options. These aren't your typical stocks or bonds. They come with additional risks. For instance, if the counterparties in these derivative contracts fail to meet their obligations, the ETF could suffer major losses. Moreover, these products tend to have higher expense ratios than traditional ETFs. That's because managing leveraged and inverse positions is costly. All those fees can gradually chip away at your profits, especially if you're holding these funds for longer than a day. Finally, let's talk about tax implications. Due to their frequent trading and daily resets, these ETFs can generate short-term capital gains, which are taxed at a higher rate. So even if you're making money, Uncle Sam might take a bigger bite out of your returns. The bottom line, these ETFs are not for the average investor. Understanding their risks is crucial if you're thinking about using them in your portfolio. Chapter 3. Real-life examples of leveraged and inverse ETF failures. Let's look at some real-life examples of how leveraged and inverse ETFs can go terribly wrong, even for seasoned investors. Back in 2008, during the financial crisis, leveraged and inverse ETFs became popular as traders tried to profit from the market's extreme swings. But holding these funds for more than a single day often led to unexpected losses. For instance, one leveraged ETF aimed to deliver twice the daily return of a specific index. However, despite the index gaining 2% over 4 months, the ETF actually lost 6%. Investors expecting double the gains were stunned by this dramatic disconnect. Another case involved a 3-time leveraged ETF designed to triple the performance of its underlying index. During a volatile period, the index itself gained around 8%, yet the ETF plummeted by 53%. Worse still, a related inverse ETF, which was supposed to benefit from falling prices, dropped by a staggering 90% over the same period. Imagine the shock of those investors who held on, believing their funds would track the index closely. One of the main reasons these ETFs underperformed so drastically was due to their daily resets and compounding effects. Even if the market moved in your favor over a longer time frame, the compounding from daily adjustments could work against you. In fact, these funds often require constant monitoring and rapid adjustments, making them unsuitable for more investors. The lesson here? What seems like a quick way to capitalize on market moves can turn into a financial disaster if you're not fully aware of how these funds really work. Chapter 4. Who should and shouldn't invest in leveraged and inverse ETFs? So, who are these high-risk ETFs actually for? Leveraged and inverse ETFs are not meant for everyone. These funds are designed for experienced, active traders who can handle short-term, high-risk trades. If you have a strong understanding of how derivatives work, are comfortable with rapid market shifts, and can monitor your positions throughout the day, then these products might fit your strategy. They're ideal for traders looking to capitalize on short-term market movements, whether it's to amplify gains or hedge against sudden drops. However, for the average buy-and-hold investor, these ETFs are a dangerous game. They are not suited for long-term investments due to the effects of daily compounding and the constant need for rebalancing. Holding them beyond a day or two can lead to unpredictable outcomes, especially if the market becomes volatile. Even sophisticated investors need to be cautious. If you aren't able to actively manage your portfolio on a daily basis, you could find yourself facing significant losses. These products require more than just a gut feeling. They demand a well-thought-out strategy and precise timing. In short, unless you're willing to embrace the complexities, risks, and daily maintenance these ETFs require, it's best to stick to more traditional investment options that align with your long-term goals. Chapter 5. Regulatory Warnings and Guidelines. Regulators like the SEC and FINRA have been sounding the alarm about leveraged and inverse ETFs for years, and for good reason. These funds are complex financial instruments that most retail investors don't fully understand. In fact, back in 2009, the SEC and FINRA issued a joint warning, emphasizing that these products are unsuitable for most buy-and-hold investors. Why are regulators so concerned? The issue lies in the daily reset mechanism. Leveraged and inverse ETFs are designed to achieve their stated objectives over a single trading day. Hold them any longer, and the performance can deviate significantly from the index they're supposed to track. This is especially true in volatile markets, where compounding effects can lead to unexpected losses. To protect investors, regulators have been pushing for more transparency. For instance, these funds are required to disclose their risks prominently in their prospectuses. But let's be honest, how many investors actually read those? That's why the SEC strongly advises consulting a financial advisor before diving into these products. There's even talk of introducing stricter rules on who can trade these ETFs, possibly limiting access to more sophisticated traders. Regulators want to ensure that investors fully understand the high risks involved before committing their money. In short, if the experts are warning us, it's a sign that these ETFs are not for the faint of heart. Chapter 6. Tips for investors considering leveraged and inverse ETFs. If you're still intrigued by leverage and inverse ETFs, there are some crucial steps you should take before jumping in. First and foremost, understand exactly what you're buying. These aren't your typical ETFs that you can set and forget. Read the prospectus thoroughly to grasp how the fund achieves its returns and what risks are involved. It's not enough to just glance at the marketing materials. Dig into the details. Second, always consult a financial advisor who has experience with these types of funds. Ask questions like, how does this ETF fit into my overall strategy? What are the potential downsides, especially if the market becomes volatile? A good investor will help you understand the risks and whether these products align with your risk tolerance. Third, if you decide to proceed, monitor your positions daily. These funds are built for short-term trades, so keeping a close eye on them is essential. Be prepared to exit quickly if the market moves against you. Holding on in hopes of a rebound can be a costly mistake. Finally, consider the tax implications. The frequent trading within these funds can trigger short-term capital gains, which are taxed at a higher rate. This can eat into your profits if you're not careful. In a nutshell, if you choose to invest in these products, make sure you're well prepared and fully aware of the risks involved. Let's wrap up what we've learned. Leveraged and inverse ETFs might seem like an exciting way to supercharge your returns, but they come with significant risks that can't be ignored. These funds are designed for short-term, tactical trades, not for long-term investing. The daily reset and compounding effect mean that even if the market moves in your favor, you could still end up with losses if you hold these funds for too long. Add to that the complexity of derivatives, high fees, and tax implications, and it becomes clear that these products are not for the average investor. If you're considering leveraged or inverse ETFs, make sure you have the experience, knowledge, and time to actively manage your positions. And remember, always consult with a financial advisor to ensure that these high-risk instruments align with your goals. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and share your thoughts in the comments. Stay informed, invest wisely, and see you in the next video.